A quiet but significant tremor is shaking the foundations of the North American auto industry, centered on the relationship between the US and Japanese automakers. For decades, companies like Toyota and Honda have been pillars of American manufacturing, employing tens of thousands. But now, a seismic shift is underway. Some of these giants are moving key production lines north to Canada. This isn't just a minor adjustment, it's a strategic retreat, driven by new trade policies and economic pressures. The decision to relocate operations signals a potential unraveling of the integrated supply chains that have defined North American manufacturing. The very cars synonymous with American roads, assembled in Indiana, Ohio, Kentucky, are now at the center of a high-stakes economic chess match. This northward migration is a direct response to a more challenging U.S. business environment, forcing companies to rethink where it makes financial sense to build vehicles. For the U.S., it raises tough questions about the future of its manufacturing base. For Canada, it's a golden opportunity to capture jobs and investment. The sight of production lines being dismantled in one country and reassembled in another shows how quickly industry can pivot in response to government policy. To understand why this is happening, we need to look at the new world of international trade tariffs reshaping the industry. At the heart of this manufacturing migration is a new, controversial tariff structure that's upending the U.S. auto market. The U.S. government has created a multi-tiered system of tariffs on imported vehicles, with rules that vary by country of origin. In July 2025, a new U.S.-Japan trade deal imposed a 15% tariff on finished cars from Japan, a special lower rate compared to the 25% tariff on vehicles from Europe, South Korea, Canada, and Mexico. This means a car built in Ontario or Monterey is now taxed more than one shipped from Japan, leaving industry veterans baffled. The complexity extends to components. Steep U.S. tariffs on imported steel and aluminum continue to drive up manufacturing costs in America. For automakers with U.S. plants, these tariffs mean higher costs for every vehicle produced, squeezing profitability. Japanese companies now face a tough choice: build in the U.S. and pay more for materials, or build in Japan and pay the 15% import tariff. The worst scenario? Building in Canada or Mexico for the U.S. market, triggering the full 25% tariff. This tariff maze is forcing companies to rethink their entire production strategies. The result? Dramatic changes to long-established manufacturing footprints. The winners and losers are now determined by trade policy, not efficiency. Honda's recent decision to shift all U.S. CR-V production from Indiana to Alliston, Ontario, perfectly illustrates this new reality. This wasn't due to lack of demand or problems at the Indiana plant. It was a direct response to the new tariff environment. The Indiana plant will stay open, but lose a major product line. By consolidating CR-V production in Canada, Honda can better manage tariff-related costs. Shipping CR-Vs from Canada to the U.S. means paying the 25% tariff, but that's more predictable than navigating tariffs on every imported part in the U.S. Modern auto supply chains are global, and tariffs on parts act as a persistent tax on U.S. manufacturing. Honda is choosing a single, predictable tariff over a complex web of costs. The Alliston plant is getting major investment to handle the increased workload. Honda's move is a test case for how automakers might adapt to a trade landscape that penalizes North American integration. For Japanese automakers in the US, the Made in America label has become much more expensive. Decades of investment in US factories are now undermined by tariffs on steel, aluminum, and imported parts. These costs are showing up in corporate balance sheets. Toyota's North American division reported a $1.1 billion operating income decline and a $438 million net loss, despite strong sales. Strong sales with negative profits show the cost of doing business has become unsustainable. Automakers once absorbed tariff costs to keep prices stable, but as policies persist, that's no longer viable. Now, companies are starting to pass these costs to consumers, often disguised as routine price hikes. Japanese automakers have done what US politicians asked, invested in American jobs and factories. Yet, the current tariff structure penalizes this investment, making it more expensive to build in the US than almost anywhere else. The result? Companies are looking north to Canada for more cost-effective production. The paradox is clear. Policies meant to protect US manufacturing are driving it away. The financial pressure is forcing a fundamental rethink of where cars are built. These strategic shifts have real consequences for American workers and consumers. For auto workers in states like Indiana and Ohio, moving production lines means uncertainty, fewer overtime opportunities, and a blow to long-term job security. The impact ripples out to suppliers, threatening jobs throughout the local economy. The promise of stable, well-paying manufacturing jobs is now undermined by national trade policy. For car buyers, the result is higher prices and fewer choices. Automakers can no longer absorb tariff costs, so sticker prices rise. Some models may disappear from the US market entirely if they become unprofitable. The end result: a less competitive market, with fewer options and higher costs for everyone. As the US faces manufacturing losses, Canada is emerging as a clear winner. Honda's move to Alliston, Ontario, brings new investment, upgraded facilities, and more jobs. Canada's stable trade policy, skilled workforce, and government incentives make it an attractive destination for automakers. The benefits ripple through the Canadian economy, boosting suppliers, logistics, and local communities. Canada is positioning itself as a hub for both assembly and innovation, especially as the industry shifts toward electric vehicles. The US tariff strategy has inadvertently created a golden opportunity for its northern neighbor. For every production line that moves north, Canada gains jobs and economic activity that might have stayed in the US. It's a classic case of one nation's policy creating an unexpected windfall for another. America's own automakers are among the loudest critics of the new US-Japan trade deal. Companies like GM, Ford, and Stellantis argue the tariff structure is fundamentally unfair. While Japanese competitors pay a 15% tariff, US automakers face a 25% tariff on vehicles built in Canada and Mexico, even when those vehicles use American-made parts. This puts US companies at a disadvantage in their own market. Ford, for example, expects over $2 billion in tariff costs in 2025, directly impacting its ability to invest and compete. The policy penalizes North American integration, which has been key to US automakers' competitiveness. Instead of protecting domestic industry, the deal gives foreign rivals a leg up. Industry groups are urgently calling for a level playing field and similar tariff reductions for Canada, Mexico, and other partners. The frustration is palpable. The current system picks winners and losers based on trade deals, not merit. US automakers want fairer rules that don't undermine their own investments. As the dust settles, experts predict more uncertainty and strategic realignment ahead. As long as the current tariff structure remains, more automakers are likely to follow Honda's lead and shift production out of the US. Canada and Japan now look more attractive for building cars destined for the American market. For US workers, the outlook is precarious. Fewer shifts, less investment, and persistent job insecurity. Consumers should expect higher prices and fewer choices, as automakers pass on costs and cut unprofitable models. The dream of an affordable new car may slip further out of reach for many Americans. Trade groups are lobbying for broader, more integrated agreements that don't penalize North American production. The key question: will policymakers listen? If current policies persist, experts warn of a fractured, less efficient, and more expensive North American auto industry. The future of the industry and its workers hangs in the balance.